December version of Farm Office Live. This is a special edition, our farmer and farmland owner tax webinar for 2024. Boy, it's hard to believe that we've gone through another year. It seems like we just did one of these last week, but obviously it's been several of those. So welcome. It's great to see so many of you and a lot of familiar names on there. Welcome if it's your first time. We think we've got a great session lined up for you here. There's a lot of information on this title slide. I'm just going to touch on a couple of these pieces. Of course, the title, we're here today with you. We're going to be going from 10 to noon. There's a whole list of topics that we're going to try to address, some in a little bit more depth than others. The members of the team that are going to be speaking and presenting today are there on the right. And there's also an option or a link there if you want to register and watch replays. If you're already with us, that means you've already registered, but we will record this and just making sure that we are recording. Okay. Thank you, Jeff. And this will be available for you to access on our Farm Office Live page. So you can go there and watch it all again if you missed something or if you really just love to discuss and think about taxes. So let me just go down through a couple of things here. This is our Farm Office team. There are 8 of us shown here. There's 4 of us on the top that are going to be presenting today. And we're also happy to have Peggy and Clint with us to provide support for us today. We need all the help we can get sometimes. So we'll go through this. Myself, David Marison, Jeff Lewis, and Robert Moore will be presenting for this Farm Office Live. If you have questions, we recommend and we encourage you to drop questions in our Q&A feature. You know, you have a couple of features that you can interact with us, but it's easier for us to track and then finally answer some of those questions if you do put those in that question and answer feature that you should have access to at the bottom of your Zoom screen. Also, we have a chat feature. If you just want to throw up a comment or if you have something technical in nature in terms of the webinar process itself, we will also drop some links in there for you to access. Okay, so that's interaction with us. Sorry. And I am going to kick us off in discussing basically the farm economy. And we're going to talk a little bit about, I guess, setting the stage for the rest of this webinar. The farm economy and farm income, it's going to be an important part of the way that you tax plan. Okay, there's no revelation here. We know that the overall the farm economy has taken a dip here in the last couple of years. We're coming off 2 or 3 pretty good years. If we were to go back and look at 2021 and 22, we had some significant net farm income. And many of you out there, or if you're tax practitioners, you were working on behalf of your clients to help manage some of those taxes. In some cases, that meant significant purchases to offset some of that gross income, and also pushing some of that income to the subsequent year or actually paying more prepaid expenses in that tax year. So there were lots of things that were done in managing some of those high income years, and being cash basis taxpayers, as most farmers are, it just gives a lot more flexibility. But you can see there at the very right-hand side, this is all U.S. net farm income. It does mask a little bit what's going on in the specific sectors, which I'll talk about in a little bit more detail. Okay, this paints a pretty bad picture for those that are raising commodity crops here in 24 and the outlook for 25. This is the returns to land for Ohio corn. And fortunately, though, we're coming off some pretty good years as we go into this rather dismal looking farm income in 24 and possibly in 25. In 2021, we had one of the highest years in recent memory for net farm income, especially if you were producing crops, surrounded by a couple of really good years as well in 20 and 22. 23, not so good as we transition and we started to see those commodity crop prices fall. And now we're in this period where we're uh, fighting to find any kind of positive margin. So this transition period, there's some things that we can look at, and David's going to talk about some of the things and how to manage a low income year for tax purposes. But one of the things that we want you to understand as we go through this transition process is that we need to be aware of this transition. We need to be very aware not only of net farm income in the current tax year, but the likelihood or the prospects for the next year or two, and trying to gauge that. And we know that it's impossible to really accurately predict what's going to happen, but we do have a fairly decent idea, at least, of what the outlook is for this next year. And that helps us with our tax planning. So discussing with your tax practitioner and trying to get the best strategy laid out for finishing this year and also looking forward to the 25 tax year. This is a little bit more specific as far as net farm income for the three specific main commodity crops in Ohio. Not much new beyond what I showed you a slide or two ago. We're looking at very, very small margins in 25, so the outlook is not so good for crop producers. Now, on the flip side, all of those corn and soybeans, or a majority of them, are used for feed in the U.S. and also some is exported. So it's important to note that I think while our crop producers are looking at lean times in this year and next, that some of our livestock producers may see an uptick in net farm income. I've got a whole mess of text on here, so I apologize. But if we look at the swine pork industry, it's fairly highly integrated in Ohio. But there are some of you out there that may be raising swine. It looks like it's going to be a mixed bag next year. Not huge margins, but there may be some opportunities in certain periods due to the cyclical nature of the swine industry. There may be some positive margins in the early part of 25, followed by some smaller margins. Lots of variables involved here that may change that, but generally not huge margins. But overall, pork, cattle, poultry, dairy should see a slight uptick in net farm income due to the fact that feed prices will likely be lower for most of these sectors. Cattle beef, this is one of the big bright spots in talking to farmers across the state, and talked to one just yesterday at one of our tax schools that raised cattle, and they were talking about significant profit opportunities in the cow-calf herd and selling feeder calves. So this is going to be an area that if you're one of these producers, or if you're working with some of these producers, make sure that you understand that this is not going to be probably a low income period for that sector. Poultry, this is something where we're going to see a similar outlook in 25. Not huge margins, but there's the possibility that there will be. It depends a little bit on the avian flu or the bird flu and how those outbreaks may occur throughout this next year. The dairy sector margins are probably going to not vary a whole lot in 25. The milk price outlook is pretty stable. And for those large herds that have lower costs per hundredweight of milk produced, they're probably going to continue to see some possible positive margins as they look forward into 25. So it's a mixed bag here as we look at livestock as compared to crop producers. And just understanding what the outlook is help you better manage that. One last point that I'll make, and I know we've gotten used to managing taxes by perhaps buying a lot of equipment, installing some extra field tile, maybe installing grain bins with those high gross income years to offset some of that income for tax purposes. I really strongly recommend, as you evaluate 24 and try to determine how many of those bushels you sell this year versus next, how much prepaids that you finally do go ahead and pay for, and how many other things that you might purchase to expense or write off in the 24 tax year, make sure that you have a check-in with your ag lender. Having some cash reserves going forward into this next year may be an important part of your overall financial plan. So, okay, with that, I'm going to turn next to Robert, and he's got a busy day, and he's got to be at another meeting here after bit. So we're happy to have him with us and talking a bit about estate taxes and pending possible changes there. So Robert, I'll turn it over to you.
All right. Thanks, Barry. And can you see my slides okay? I still always want to make sure.
Yes.
Okay. All right. So I'm just going to make a few comments on where we are currently with federal estate taxes and what we may anticipate into the future in the next year or two. So currently, Ohio does not have estate taxes. Those were abolished in 2000, and I got a typo there, abolished in 2013 by the Ohio legislature. So back when I first started practicing, we did most of our estate planning was based around trying to minimize Ohio estate taxes. But fortunately, we don't have to worry about that anymore. But we still do have federal estate taxes. The current exemption today is 13.6 million. The IRS recently published the exemption for 2025, and it's $13.99 million. If anybody can explain to me why the IRS could not just simply round it to 14 million, I'd really like to know why that is. But anyway, it's 13.99 million. I'll probably use 14. Also keep in mind, these are for individuals. So a married couple in 2025 will have $28 million of federal estate tax exemption. And a lot of people don't realize how high these exemptions are. And very few people pay estate taxes. And I found some data from USDA that this is a few years old, but at the time of this was published, they were predicting that for 2023, about 40,000 farm operators would die. And of those operators, only 89 would owe estate taxes. So it's just not common at all that many people or many farm operators owe estate tax. And it's not a big revenue source for the federal government. Only about 3% of our federal revenue comes from estate taxes. So I guess my point is that estate taxes are not a big source of revenue for the federal government. So maybe that's a good thing. Maybe we can get some favorable legislation in place or extend it. So that's where we are today. Most of you probably know that in 2018, when the Tax Cuts and Jobs Acts went into place, it essentially doubled the estate tax exemption, but it only did that for 7 years. And they had to do the 7 years to satisfy all the parliamentary issues to get it passed with a simple majority, is my understanding. And so the estate tax exemption is set to sunset at the end of next year. And if it does sunset, it will go back to 2017 values, which is about 5.5 million plus inflation. So based on the increases we've got in the last couple of years, it'll probably be around $7.2 million. So that's still a significant exemption, but half of what we have now. So we're in this bit of a dilemma of what do we do? What will the estate tax be a year and a half from now? So Congress can simply extend the current exemption amount or make it permanent. Now I say simply because they could just extend the current legislation. Nothing simple is happens in Washington, particularly with Congress, probably. But I will say, due to the recent election and Republicans soon to control the White House and both houses, I think it's much more likely now that it will get extended or made permanent than I would have thought a few months ago. So it's anybody's guess what will happen, but based on my very amateurish opinion on the politics of Washington, it just seems like unlikely that a Republican Congress is going to let these tax cuts sunset. I don't think the White House would be very happy with that. So sure seems like the exemption will get extended. There was talk last time of abolishing estate taxes altogether. For whatever reasons, and I'm not trying to make this political at all, but Republicans in Washington seem to find estate taxes, repugnant and want to get rid of them. So maybe they'll abolish estate taxes entirely. I doubt it, but it could happen. But I think there's a pretty good chance it will get extended, but who knows? That's just my guess. Your guess is as good as mine. Okay, let's talk a little bit about reporting estate taxes, what's required. So if someone dies and their net worth exceeds the federal estate tax exemption at the time, a estate tax return, a 706, must be filed, and it tells the IRS here's how much assets they owned, and here's how much taxes are owed. Estates with a net worth below the exemption are not required to file estate tax returns. However, we get into this issue of portability. And if you're not familiar with portability, what this is for married people, when a spouse dies, if they don't use their entire exemption amount, then an estate tax can be returned for that estate, and the surviving spouse can use the unused portion of the deceased spouse's portability. So back when I said spouses have double the exemption, that's assuming that you use portability. If you use portability, an estate tax must be filed. You can't just say we've got $2 million extra and apply it to the surviving spouse's estate without a tax return. You must file an estate tax return. However, that estate tax return is not due for 5 years after death. So what are some of the strategies that maybe we're looking at for federal estate taxes? So for the vast majority of people, their net worth is under 7 million or 14 million. So, and again, 14 is for married couples. So even if the exemption does sunset, it comes back to 14.7 or $14 million. The vast majority of people are still going to be well below that, so they don't need to worry about estate tax returns. If we think Congress is going to extend or make permanent the estate tax exemption, now we're looking at 14 million or 28 million for married couple. So now we've got even more people that are not going to have to worry about estate tax returns, but that's a bit of an unknown. So for unmarried people, it's very simple. If they die and their net worth exceeds federal estate tax exemption, you file a state tax return. If they're under the exemption, you don't, because there's no portability to use. For married people, it gets a little more complicated, or it's a little bit more of a guessing game, because it's like, well, do we file an estate tax return to preserve the portability? And you might think, well, why not? What's it hurt? Well, it takes time and money and resources to file these estate tax returns. They're not simple returns, and you got to get all the appraisals and all the business entity valuations. And the attorney or the accountant has spent a lot of time putting these returns together. So, that's why we may forego the portability, is to save the time and resources on the estate tax returns. I do want to point out, and this is really important, is that even if an estate tax return is not needed because the person is under the estate tax exemption, we still want to get appraisals on everything because we need that stepped up tax basis on all the assets. So even if somebody dies and they're well below the estate tax exemption, we still want to get all the land appraised in buildings, in equipment, and want to put a value on the grain, because that stepped up tax basis is extremely valuable to whoever will be inheriting those assets. So even though we may not need to worry about estate tax returns that often, those appraisals are important for each and every estate. So I just got an example here of kind of what I'm talking about. We've got a married couple with a combined net worth of $20 million. Husband dies next year with a net worth of $10 million. Well, the $10 million is less than the $14 million, so we don't have any estate taxes to any estate tax return to file. But the issue becomes, well, we've got $4 million that the husband didn't use. Should we file an estate tax return to preserve that $4 million for the spouse? Because if the exemption comes back down to $7 million and the surviving spouse is worth $10 million, now we've got estate taxes. And this is kind of the guessing game. Do we do this or not? In this case, if the surviving spouse is worth $10 million, it probably would be worth it to spend the money on an estate tax return. But what if they're only worth $10 million and the surviving spouse is only worth $5 million? Is it worth the money, the legal fees and the cost to file the estate tax return for portability then? Yeah, I'm not sure. So, like I said, it's a bit of a guessing game, but that's why for married couples that may have a net worth, somewhere, over that $14 million that could be the exemption amount after the sunset, it becomes a bit of a guessing game. And I would just say, talk to your attorney and accountant and, see what the best strategy for you is. So, yeah, unfortunately, we're in a bit of a guessing game until Congress tells us what they're going to do. And it may be this time next year or later until we find out what Congress does. So we could be sitting here on December 31st next year still wondering what estate taxes will be for 2026. Okay, that's all I had. Again, just kind of a quick summary of estate taxes. I don't know if we've got any questions, but if not, I'll turn it back over to Barry or Jeff.
Yeah, I don't see any questions, Robert, not showing up yet. So
Yep.
Thank you. And Jeff's turn.
Yeah, I am trying to share my sound real quick.
All right. There's one question. I think they're requesting, what is the annual gift allowance per person?
Yes, and the annual gift exemption right now is $18,000. That goes up every few years, but for 2025, I think it's still $18,000, which means you can gift $18,000 of cash or land or anything to as many people as you want every year. And it's a free gift, no tax, and doesn't affect your federal estate tax return.
Okay, I think that's all I see, Robert. So I'll thanks for being with us. I know you got to get on the road, so we'll catch you. If we get any more questions, I may send them to you.
All right, we'll do that. Thanks.
Thanks, Jeff. It's all yours.
Barry, we might have to make an audible here. My computer is not letting me share sound, so
okay.
I will go ahead and start my presentation and load up David's.
Give me just 1 minute and let's see if we can do this. And I can go ahead and share that.
Sorry, folks. Technical difficulties. It's Friday.
1 minute, and we'll see if we can get this done. Oops. Let me try that one more time. All right, Jeff, we are going to have to call that audible, and you go ahead and proceed with your section, and I'll see if I can work out David's recorded version.
You got it. All right, folks. I am talking today about two things that are in limbo really now. And you'll hear more about this at the end of this specific portion of the presentation, but we had a new ruling come out a couple days ago that might put the Corporate Transparency Act into question. But I wanted to go over what the Corporate Transparency Act is for those of you that don't know what this law that was in place that took effect on January 1st of this year. If you don't know what the law is and what the requirements are for you as a business owner, we're going to go through that. Then we're going to go over a few questions that have been popping up in our tax schools. And then we're going to talk about that court case that came up. So, as I said, the Corporate Transparency Act took effect on January 1st of this year. And the goal of the law was to combat money laundering, illicit financial transactions, and financial terrorism. And so what it does is that it requires what the Corporate Transparency Act, or the CTA, does is that it requires many businesses that are formed or operating in the United States to comply with this beneficial ownership information reporting rule, and we'll call it the reporting rule. And so the reporting rule requires that certain business entities file what we call a BOI, or a beneficial ownership information return, to FinCEN, which is the Financial Crimes Enforcement Network. And those businesses that must report are mainly those businesses that have filed something with the Secretary of State of their jurisdiction where they are in, where they were formed. Some states don't have a Secretary of State, but there's a similar office. In Ohio, we do have a Secretary of State. So if you're a corporation or a limited liability company, limited partnership, and there's multiple others, you have to file with the Secretary of State to be a registered company in Ohio. And if you do that, that means you are subject to the Corporate Transparency Act, unless you meet one of the 23 exemptions, which we will touch on in a minute. That means, however, that in Ohio, a sole proprietor and general partnerships do not have to report because they do not file anything with the Secretary of State when they are formed. This is a list, and you do have access to these slides that you can read over. I'm not going to go through everything on some of these lists, but you can see here that more likely than not, unless you're a sole proprietor or a general partnership, you're probably going to have to file a beneficial ownership information report according to the law as it was written. Now, there are exemptions for certain entities like banks, credit unions, insurance companies. I do want to touch on this number 15 over here, this accounting firm. That is a strict definition of accounting firm. So if you are an accountant, it's not just that you're an accountant and you're exempt from BOI. It is those accounting firms that are certified public auditors. They have a special license. I think it's from the PCOAB, I believe is the acronym of the entity that licenses these accounting firms. But essentially, you have to be an accounting firm that does audits of publicly traded companies. those are the accounting firms that are exempt. And then I also want to highlight number 21, the large operating company and the inactive entity. And so for the large operating companies, if you are a business entity, any of those that are possibly subject to reporting the BOI, but you qualify for this exemption, then you do not, right? But only entities that employ more than 20 full-time employees in the United States, have an operating presence at a physical office within the United States, and have reported more than $5 million in gross receipts or sales, they do not have to file a BOI return or a report. That's also true for inactive entities. Now, we might know someone that has, personally, I do know someone that has created an LLC many years ago. And they created that LLC for the name only. They wanted to protect the name. And so they have not done anything with the LLC. And this was many years before the Corporate Transparency Act was even thought of. So the question has arisen, do they have to report a BOI on the information on a BOI? And the answer is, if they were formed or in existence before January 1st of 2020 and meet these other 5 criteria, which essentially amounts to they have done no business, then they do not have to report. So the entity that was in existence before 1/1/20 and has essentially done no business does not have to report or file a BOI. So what is this BOI and what has to be reported? A reporting company, or the entity that's been formed under the Secretary of State or similar office, has to report the beneficial ownership information. So what is that beneficial ownership information, or a beneficial owner? Is any individual who directly or indirectly exercises substantial control over a company, or owns or controls at least 25% of the ownership interest of a reporting company. So a reporting company can have multiple beneficial owners. For example, a reporting company could have one beneficial owner who exercises substantial control over the reporting company, and a few other beneficial owners who own or control at least 25% of the ownership interests. Conversely, a reporting company could have one beneficial owner who both exercises substantial control and owns or controls at least 25% of the ownership interest. There is no maximum number of beneficial owners who must be reported. So what is substantial control? Substantial control is established when an individual exercises control over a reporting company and meets any of the following criteria. If they are a senior officer, if they have the authority to appoint or remove certain officers or a majority of directors, they're an important decision maker of the reporting company, or they have any other form of substantial control. So it's very broad. Substantial control is a very broad definition. Essentially, if the person is not an owner, but they're able to make management and ownership type of decisions, they're probably a beneficial owner and need to be reported on that BOI report. And so the BOI report requires 2 things. One thing from the reporting company, one set of information from the reporting company, and another set of information for each beneficial owner. So the reporting company has to state its full legal name, any trade name or doing business as names that they use, a current U.S. address, the jurisdiction of formation, and their tax ID number. For a beneficial owner of a reporting company, you have to provide the full legal name, their date of birth, complete current address, a unique identifying number and issuing jurisdiction from one of the following, along with its image, right? So we need the unique identifying number from an issuing jurisdiction and the image of either a U.S. passport, a state driver's license, or another identification document issued by the state, local government, or tribe. If there is a foreign owner and they don't have a state driver's license or any identification from a state or U.S. passport, their foreign passport will suffice. So we could see from this alone why there has been uproar really with the reporting requirements of the Corporate Transparency Act. And so many feel that they don't want to provide this information to be put in a database with what's really been unclear about who's going to all have access to this database. Is it just going to be the authorities? There's, your banks, when you create a new business, are now asking if your BOI report has been filled out. So who all has access to this database? And there's been an uproar in terms of needing to file these requirements or fulfill these requirements. So as the law was written, again, this has all been changed in the past few days. So take all this with a grain of salt, if you will. But as the law is written, when does your company have to file its initial BOI report? So if the company was in existence prior to January 1 of this year, you have until January 1 of next year to file your BOI report. But if you formed your business after January 1 of this year, you had 90 days, 90 calendar days to report or fill that BOI report. Moving forward, any company established or business established after January 1st of next year will have to file the BOI report within 30 calendar days. And you see the word initial BOI report here, and that's because, as we will discuss here in a few seconds, the BOI is not just stagnant. So people will change their addresses, change their names if they get married, what have you. So the BOI information has to be updated. And so when does it have to be updated? If there is any change to the required information that you have reported, then you have 30 days after that change has occurred to report that to FinCEN. Again, this has been an issue with those subject to the law about the continuous compliance aspect of this law. And there's been also some upheaval in the accountant world versus the attorney world, and whether or not performing this for your client is the practice of law. So there's still confusion out there in terms of reporting and the requirements to report for BOI. So here are some examples of changes that would require an updated BOI report. So if you have any change to the information that you've reported to the FinCEN or to FinCEN, or your company has registered a new doing business as name, if there's a change in beneficial owners, such as a new CEO or a sale of ownership interest that changes who meets that 25% threshold, or if there's any change to the beneficial owner's name, address, or they change their passport identification number, or their identification number on their driver's license changes. I don't really know when that would happen, but allegedly it could. So I just want to make one note here, though, that if there's a death of a beneficial owner, you're supposed to update your BOI report. But when a beneficial owner dies, the resulting changes to the reporting company's beneficial owners, those changes must be reported within 30 days once the deceased beneficial owner's estate is settled. So it's not 30 days from the death, 30 days from the day that the deceased beneficial owner's estate is settled. So who can file a BOI report? Touch on this a little bit. You can be the owner of the reporting company that has to file the BOI report, or you can designate a third party. And here the example is your attorney. Again, there's been some discussion amongst accountants whether or not they should be filling out these BOI reports for their clients, because their errors and omissions insurance has come out and said that it's the practice of law and they will not be covered if there is a malpractice suit filed against them. So some of them are not. We've heard that some are filling out the BOI report for their clients. It's really up to the individual accountant. But the point of it is you can designate a third party to fill out your BOI report. BOI reports are submitted through the FinCEN website at fincen.gov/BOI. And there's a lot more information on there too. If you have questions, they have frequently asked questions. There's a small entity compliance guide. That's a great resource. And this is the big sticking point too of the Corporate Transparency Act, is that there are penalties for failing to report. And right now, the penalty is $591 for each day of the ongoing violation. That $591 will be adjusted for inflation as we move forward. But the maximum you can be charged is $10,000. There's also the potential imprisonment for up to 2 years criminal penalty associated with this. So it is a very serious and could be burdensome penalty if you fail to report the BOI information. So some questions that we've had pop up throughout tax schools is that if an entity, one that is required to report, has ceased business before December 31st of last year, so December 31, 2023, but they have not formally terminated its status or dissolved the business, are they required to file a BOI report? So again, that is a company that's supposed to report, but they've stopped doing business before this year, but they've not officially terminated or dissolved their company. The answer is yes, they must file a report because it's not that inactive entity. It was established after 2021. It's done business within the past 12 years, or 12 months, sorry, in the past 12 months. So that entity must report to the BOI that its information. Now, unless that entity has entirely and completely completed the process of formally and irrevocably dissolving, they will have to file. But what does it mean to have an entity have formally and irrevocably dissolved? It essentially means that there is paperwork filed where the company was created saying, hey, Secretary of State, we no longer want to be a company, we're dissolving, and you will get a notification back that you have formally dissolved or unregistered your company or business. That's essentially what you need to have formally and irrevocably dissolved your company. Just ceasing business operations is not sufficient. So when an entity has filed its initial BOI report and then legally ceases to exist, again, that is legally ceases to exist, they have filed their dissolution paperwork with the Secretary of State or what have you, does that company have to notify FinCEN that it no longer exists? And the answer is no. There's going to be no update needed for that company that ceases to exist legally. And here's the fun part. So we've gotten a few days ago that court case I talked about. The U.S. District Court for Eastern District of Texas has issued a nationwide preliminary injunction against the Corporate Transparency Act. And that court has concluded that the Corporate Transparency Act appears to be likely unconstitutional. So the court has, at the present, halted enforcement of the Corporate Transparency Act and has stayed the January 1st, 2025 deadline for BOI reporting. So what does that all mean? It means technically businesses who have not yet filed their BOI information with FinCEN are not currently required to do so. The court case did not address or include any remedies for businesses that have already filed their BOI reports. But I want you to be aware that the lawsuit is not over. There is a possibility that this could be taken up on appeal and reversed. And then the Corporate Transparency Act is in full-fledged in effect again. But I'm sure there will be language in there about extending time or allowing people to fulfill their obligations. But as of right now, the law is that there is no requirement to fulfill the BOI reports and fulfill your obligations under the Corporate Transparency Act. Again, stay tuned. We will keep you up to date on the Farm Office website. Peggy wrote a great blog post yesterday or 2 days ago, about this court case. And I do have that on my resources page that you have access to in the slides. I talked about the small entity compliance guide. It's a great resource if you're looking for information. Robert wrote a law bulletin on the Corporate Transparency Act and the reporting requirements. And again, there's Peggy's blog post about the recent court case that came out and its halt of the CTA. Are there any questions as we move forward on the Corporate Transparency Act?
Okay, Jeff, there are a number of questions, but what I'm going to do, if you don't mind, is give you a chance to process those and try to share David's presentation next. And you may be able to answer some of those by typing in the answers to some of those questions, and some of them you may have to do a little bit of looking on. But there's like 5 questions in the Q&A feature on this particular issue. So I'll give you a moment to go through and process those. When David's done, when we're done with his presentation, then we'll come back to you. And if you have some additional comments from these questions, then you can answer those.
Perfect. And I will just throw in there real quick. Peggy just alerted me that the U.S. government just filed an appeal of the Texas decision. So there we are. We're already in the appeals process. So, all right, I'll turn it over to David.
Okay, let's see if we can actually get this done this time. Wait. Yeah, if it's not going to let me do it. Sorry, folks. We have David, who couldn't be with us today due to the fact that he's too busy. He's got another program that he's speaking at, presenting at this morning. So he couldn't be with us. So he recorded his session. And that, unfortunately, is not something that we're able to share. So, well, you're going to hear my comments on David's as well as my presentation. So let me just get to the front here. Okay, well, as I mentioned at the beginning and was in talking about what we will be discussing today, one of the main issues is just tax planning for low income and drought years in Ohio. Well, we were one of those drought states this year. We had significant drought, significant shortfall in crop production, and also other areas. If we look at pasture throughout most of eastern and southeastern Ohio, that was a significant concern. So there's information here that David included. There's the drought monitor, and this is a progression. We start June 11th and June 18th. It started to show up in a little bit more force, and then it only got worse. So we go into August. It continued to get worse, and it was very severe throughout September and most of October, as we had also one of the driest Octobers on record. Okay, on October 8th, this just shows the progression and a little bit of the, I guess, improvement in the conditions as we move into the later part of this fall. USDA, they issued a drought declaration. A county suffering from drought intensity declaration was released on August 30th and on, and 51 counties were classified as primary declaration counties, and then there were 18 contiguous that also allowed those counties to benefit from some of the programs and some of the USDA programs that are available for those particular drought-stricken counties. Here are the ones that are under declaration, the ones that are primary and the contiguous. There's the whole list there. It's most of Ohio, as you can see. There are USDA assistance programs, and this isn't going to be important for many out there. And this is not necessarily directly tax, but it's an important issue that many of you might be aware of and have taken advantage of. there's a nice fact sheet that David has put together. This is available on our farm office website. So you can go here and access this information on things such as the emergency loan program, tree assistance program, emergency assistance for livestock, honeybees, and farm-raised fish. There's a number of programs that if you are in one of these counties, you can take advantage of. There's a wonderful, and I know David has raved about this, a great tool that you can access on the USDA-farmers.gov to determine whether or not you have eligibility for one of these programs and how it may assist you. The emergency loan program, again, I mentioned that looking at that fact sheet, but there's details. The disaster set-aside program, also FSA borrowers can set aside one payment due to qualified disaster. So this will allow some of those borrowers to have a little bit more relief in managing this particular year and the drought that went along with it. Conservation Reserve Program, the haying and grazing program, also available there for those authorized counties. And here is the list eligible for emergency CRP grazing. There's additional clarification from Farm Service Agency as far as emergency grazing or haying also. So there's additional information that's available. And the Livestock Forage Disaster Program is one of those as well. And many have taken advantage of this due to the fact that the majority of those drought-stricken counties, well, at least the heart of the drought was in southern and southeastern Ohio, where we have a big concentration of our cow-calf herd and our livestock grazing taking place, even for smaller ruminant animals. The emergency assistance, as I mentioned, for livestock, honeybees, and farm-raised fish, also a part of that fact sheet. So there's more information there. The emergency conservation program as well. It's likely not free money. If you are going to receive some kind of assistance through one of these programs, the USDA will issue a 1099-G, and those government program payments will need to show up on your Schedule F. So there's additional assistance also, and watch for this, House Bill 683. Although whether or not this actually gets done in some type of lame duck session and attached to other emergency assistance, time will tell. You know, there was speculation that this House Bill 683 that will provide funding for some of those hurricane-stricken areas might also include some assistance for farmers. So that's something we're continuing to watch. A lot of things here as far as just reminders on financial management, the importance of record keeping, looking at budgets and completing your own budgets, as I mentioned up front, having a good idea as far as that upcoming year and the taxable income that you might actually have in tax planning and trying to move income from one year to another. Crop insurance disaster payments. Through Internal Revenue Code Section 451, it allows 1 year of deferral for crop insurance proceeds. Most of the crop insurance that farmers do have is in the form of a revenue insurance product. And this revenue insurance product has two components, and we can get an indemnity payment based on a decrease in price or a decrease in yield throughout the growing season. The portion of that revenue or insurance indemnity payment that some producers may get this year, the portion that's deferrable is that part due to yield loss, okay, due to drought circumstances in this particular case. The Farmer's Tax Guide has some additional information, language there discussing this particular issue. The revenue protection payments, again, as I just mentioned, there's a great example here that David shares that goes through all of the different math that's associated with trying to determine what portion of an indemnity payment, an insurance indemnity payment might be deferrable to the subsequent year, to the next year. So this is just a reminder, making sure that we understand that this is an option. Many of you may have higher income years this year in 24 than you expect to have in 25. So this is a tool that we can push some of that income into the next year and take advantage of lower tax brackets, perhaps. And there's additional information on that. Weather-related livestock sales. So some counties and some farmers out there may have had to sell livestock perhaps when they didn't want to. Okay, if we take, for example, a cow-calf herd, you didn't have enough forage, you didn't have enough pasture, no hay, you may have had to sell some mama cows earlier than what you might normally have wanted to do. If you had to do that due to the drought, you can have up to 2 years to replace that livestock without recognizing that sale, that gain on that sale of those beef cows in this particular example. So this gives you some flexibility, deferring that to until you have a chance to replace those particular livestock units. In the instance this year where we had federally declared disaster areas, most of Ohio, you have up to 4 years to replace those particular livestock. So this gives us a lot of flexibility and not having to recognize that income for tax purposes. And that's under IRC 1033E. Okay, so again, we're listing some of these counties that we extend that replacement period. There's another Internal Revenue Code section 451G that allows us to defer income, and this is primarily targeted at market livestock. Okay, so if we have some background, we're backgrounding some feeder calves, and we had to sell those due to a lack of forage, poor pasture, no hay, we can defer that any excess sales. So in other words, sales that are above and beyond what we normally would have sold in a given period. Okay, so this is also part of the language that's used on that previous Internal Revenue Code section. So if you had to sell livestock that was above and beyond what you normally would have sold, you can defer that particular gain or that income until the following year in this case and for this code section. So if you had to sell some livestock, whether it be breeding livestock or market livestock due to a lack of pasture or forage, it's time to review these particular 2 sections to determine whether or not you can defer or have a replacement period of 2 to 4 years for that breeding livestock. It gives you a lot of flexibility. It allows you to, again, manage some of that income in this year and next to try to put some of that income into a lower tax bracket. Okay, there's some farmers out there. Some of you may experience this. You may have a net operating loss. We don't typically have a lot of these, or we haven't had them lately, but what it allows us to do is take a net operating loss in, for example, this year, and distribute that loss into a year where we may have had significant income and mitigate some of that net farm income and lower that particular tax bill in that year. Okay, so this example and in this particular example I'm talking about, I guess, is that we can take a negative year in 24 and take some of that negative income and allocate that to the 23 tax year and lower that tax bill in that particular year. The one thing that farmers do have is that they can take a net operating loss and they can take that back 2 years. With the Tax Cuts and Jobs Act that was incorporated starting in 2018, legislation was passed in 2017. It allowed farmers to still have this opportunity to carry that net operating loss back. In this case, now 2 years. Most other businesses do not have this opportunity, and we can also carry those NOLs forward indefinitely. Okay, farm loan relief under Inflation Reduction Act there are corrected 1099s out there. There are very few out throughout Ohio that actually had this happen, but as a part of the Inflation Reduction Act in 2022, the Farm Service Agency, that if you had direct or guaranteed loans, which were 60 days or more delinquent, there was an opportunity to seek and be granted debt relief. All right, farmers who benefited from this program received a 1099-G, and there's more information here as well. But in some cases, they reversed their option in terms of sending that, and they instead sent a 1099-C, or a cancellation of debt. Were issued in April of 23. If that wasn't recognized or there wasn't a change there, then there may still be an opportunity to file an amended return for that particular issue if that did occur. There's more information, ruraltax.org. There's an excellent fact sheet here, and this is all available to the public. This is one of those this is a multi-state venture, and Ohio State's a part of this rural tax education website, so you can access this information as well. All right, I'll talk a little bit more about this towards the end in terms of planning for the future as we talk and about some of the different programs that are upcoming. But I don't see any questions on this particular set of information. But there are a number of things that we do have to consider as far as a different planning progress, or a different planning process as we transition from high income years to lower income years. All right. There's a question that came up from Anonymous that if I received a crop insurance payment, is there a process to separate the yield and revenue to defer the yield loss to the following year? So I think trying to separate the yield and the price component of the loss and the indemnity payment. There's an example that I can share with you. There's also one that David shared there. One of the things that was recommended too, and I think this is a good recommendation, is to discuss this with your crop insurance agent and have them go through the process of breaking out the different parts. So it can be done. I also got an additional exercise, an additional example that wasn't included in this particular set of slides that I'm happy to share. So you can reach out to me and email me directly at ward.8@osu.edu, and I'm happy to share that additional information. Okay, good question though. Okay, let me switch gears and get to what my section is today. I've got a number of things that I'm planning to talk about. A whole list here. We're going to talk a little bit about the clean fuel production credit, tax credit, residual fertility deduction, which is getting a lot of time in the farm press. Current ag use valuation. So we'll switch over to property tax and discuss some of the changes that we're seeing this year and the prospects for upcoming years. We'll talk briefly about the research and development tax credit and how promoters are really being aggressive in the farm community, and the taxability of USDA discrimination awards, different than the ones that we had talked about and were included in David's slides. Okay, this first one, this doesn't have any direct applicability to most of us as taxpayers, as farmers, but it may have an indirect effect on many of us. So it's something to keep an eye on. I just wanted to put this out there for information purposes. The clean fuel production tax credit, it applies to qualifying transportation fuel produced after December 31st, 2024 and sold on or before December 31st, 2027. So this tax credit's available for those that are out there manufacturing these fuels. Okay, so biofuel producers are the ones that can take advantage of this particular tax credit. And what they're looking at doing is incentivizing these biofuel producers to produce sustainable aviation fuel and also non-aviation transportation fuel. So that's the real thrust of this Internal Revenue Code Section 45Z. I know Peggy has been involved in some discussions on this and been heavily involved in trying to interpret this particular piece of legislation and how it may be meaningful and impactful for the ag community. Okay, so it's, as I mentioned, available to the producers of clean fuel, not farmers, not the regular taxpayers. If the biofuel producers purchase corn or soybeans from farmers reducing carbon emissions and have a low carbon intensity score, that CI score, through practices such as cover crops, no-till farming, or in other words, climate smart practices as they define them. So what the expectation is, and here how farmers may benefit, is that the fuel producers seeking these tax credits, they will pay farmers a higher premium for their grain or a higher price for their grain, but the amount of the premium still remains uncertain. So that's something that we'll continue to watch. Okay, I mentioned up front the residual fertility deduction, the excess fertilizer deduction. It's got a number of different names depending on what article that you read. Largely driven and explained through Internal Revenue Code Section 180. There's some additional language here, but the big part of that Internal Revenue Code section is just the allowance or allowing us to expense or deduct expenses for soil amendments. So what you typically put on your Schedule F for all of the fertilizer and lime that you purchased in a given year for crop production. So that's mainly what that code section is addressing. That also states that land used in farming means just as you would expect, land that's producing crops, or by the tenant that's producing those crops in a lease situation. The interpretation of these provisions of IRC 180 has led to the conclusion that a deduction is allowed for residual fertility that is present in the land at the time of purchase or inheritance. And this is the interpretation. This particular strategy has been used for over 40 years. Now, it's gotten a lot of recent attention and press and usage due to the fact that we've had higher fertilizer prices and also higher farmland values that we've seen across the Midwest in the last 4 or 5 years. So it's gotten more attention, and many have been using this. So the way I describe it and the way I try to make it make sense is that many of you have bought farmland over the last 20, 30 years that has had field tile already installed into that particular field. What you do typically at the time of purchase in that instance is you're going to allocate a certain amount of that purchase price to the farm itself, the land itself, and a certain amount of that purchase price to the installed field tile so that you can legally expense that or depreciate that again in some instances. So the original owner or the original installer of that may have expensed that or written that off or depreciated that initial installation of the field tile. But when you purchased it, if it has value still, you can go ahead and take advantage of that tax deduction then as well. So what you're seeing is that we're trying to determine how much excess or residual fertility that we have in the soil for a particular farm that's purchased or inherited, and allows us to then expense that particular portion that is what's considered residual. Okay, so how do we determine that? And what are some of the additional details? We have seen in recent months additional confusion and misinformation out there on this particular strategy. Part of this has to do with some of the promoters, some of the aggressive promoters out there indicating that taxpayers can take and utilize this for previous purchases back 10, 15 years. Now, this is an aggressive and we feel an improper use of this particular strategy. What you can do is you can go back and amend tax returns that are still statutorily open. So back 3 years, and those are fair game. Anything beyond that is likely going to raise red flags. So you can see here in bullet point number 2, result of this widespread promotion of this deduction, the flagrant misinformation as to the applicability and application, as well as a lack of complete technical explanations resulting in very large deductions are occurring. So this is something, and many of you may know John Lawrence, and I've utilized some of his information from our regular tax schools, and I've included some of my own information as well. But there's a lot of confusion out there. If you are being approached by some of these promoters that are indicating that you can go back 10, 15 years and take advantage of this deduction for a farm that you purchased then or inherited then, we feel that that is that's an improper use of this particular strategy. Okay, and again, the presence of highly erroneous advice on social media, it's rampant. Promotions of some individuals of very reckless advice, looking at very large amounts of this deduction. This is occurring out there. Some are even indicating that you can use a change of accounting and get through this process by doing a change of accounting. There's additional information that we can provide to you on this particular strategy and how we feel that it's not a proper use, but that's something that is beyond the scope of this particular webinar. Okay, so how do we take advantage of this? Okay, so let's take, for example, that we purchased or inherited a farm. How do we allocate this excess fertility to take advantage of this deduction? If taxpayers can show that fertilizer or nutrients are separate assets, just as I mentioned in that previous example where we typically do with drainage tile that's in the farm that we might be purchasing. If we need to separate that asset out so that we can assign a tax basis to it so that we then can expense that particular asset. So allocating them allows each of us to deduct the cost value of fertilizer nutrients instead of including the portion of the purchase price in the non-depreciable basis of the land. So this is how we need to carve it out. We need to try to figure out how much is excess fertility in this particular purchase or inherited value. The deduction is to be claimed in part in the year that a taxpayer acquires that particular land. The amount determined to be subject to the excess fertility amount is to be amortized traditionally over a useful life of at least 3 years. The IRS maintains that the deduction should be based on the amount of excess fertility over a period that reflects the percentage of use. Okay, so this is the important part. We need to strongly recommend, and this can't be stated strongly enough, that if you're going to try to take advantage of this excess fertility deduction on newly purchased land or inherited land, that you are going to do a thorough and hire someone that's a professional to do a thorough soil test of that particular farm to determine if there is excess fertility, and typically we're looking at P and K in the soil profile. Excess for soil fertility, as I think about it, would be above and beyond critical levels. So you have to break out your agronomy guide and other agronomic resources, or rely on that professional, whether they be a certified agronomist, certified crop advisor, that not only will do the analysis and do the work involved with taking the soil test, but also writing a report for you to give you some claim and some evidence that you have done your due diligence and that you can prove that there is, first of all, residual fertility. And hopefully, as a part of that report, you need to talk to your agronomic advisor that might be working with you to determine the useful life of that excess fertility. So in other words, how long it's going to take before that excess fertility might be used up in a typical crop rotation. All right, so the traditional 15-year amortization period doesn't apply in this case. Again, we have to put this as the last bullet on a timely filed tax return as well. So how do we determine this? Okay, the burden of proof is upon the taxpayer. And again, this is just reiterating what I've already discussed. Strongly recommend hiring a certified agronomist or a CCA to complete this report. All right, make sure that it's reasonable. It still could be considered an aggressive tax position. If you were to claim this deduction, you still may get some raised eyebrow from a particular federal or from a tax auditor. But if you are going to have that report in place from some kind of a agronomist or certified crop advisor that is going to give you some evidence that you have done your due diligence again. That's where you need to be. So it is common, and we've talked to some that aren't willing to pay for this report. They want to wing it, basically coming up with their own excess fertility amount on a particular farm that might be purchased. We recommend against this. In the event of an audit, we feel like this deduction may be disallowed, but there's a lot of gray area here. But that we still, again, recommend that a full report from a certified agronomist or a CCA with indication on there as far as how long it will take for that residual fertility to be used up is an important part of filing this and claiming this deduction. All right, some additional questions that have come up over the last several months or a couple of years. Do you have to reduce the basis of the land by the amount of the excess fertility cost that we then deduct? And the answer is yes. So that basis of the land for future sale would then be deducted. Since the amount of the excess fertility costs are subject to an ordinary deduction through amortization, is the amount claimed as a deduction subject to recapture? The answer is yes on that as well. So if you were to turn around and sell that farmland, you would be subject to then having to pay tax on that recaptured income. Can you take this deduction if you have previously farmed the land being purchased or inherited? This comes up a lot. And there is some disagreement. However, most would agree that this deduction is not allowable if you have previously farmed the land and been renting that from the previous owner. Primary reason that is cited in this particular instance is that it's a double deduction, or you're double dipping, in other words, on this particular set of expenses. So we would recommend not taking this deduction or not taking advantage of this deduction if you have previously farmed the land and applied fertilizer to that land. Can you take this deduction if you acquire the farmland or not a farmer? This gets tricky. If you are in the business of farming, of course, it's a much simpler deduction to take. If you are crop share leasing this particular farm that you purchase or acquire through inheritance, we feel that that is a deduction that you can take, this excess fertility deduction. If you are a purchaser of farmland and you're renting this on a cash rent basis, this is not a deduction that you would be eligible for. So in summary, the taxpayer, all of you out there that might be eligible for this, should recognize the deduction resulting from this excess fertility cost is an issue that one can actually surmise that the IRS is not familiar with. So if you were to be in a room, or you will have a possibility of a correspondence audit from the IRS, you need to make sure that you're going to have you have all your evidence in the form of this report written by a certified agronomist or a certified crop advisor that has all of the details of not only the current fertility levels, but also what is considered excess, and also the time frame that this particular professional is suggesting that this excess fertility would be utilized. Okay, so it's important for this claiming this deduction. Okay, enough on this. Let's move ahead and talk about another subject. Switching to property taxes, current ag use valuation. The second year in a row that we've seen significant increases of current ag use valuation across the state. In this particular map, it shows those counties that had seen a reappraisal or an update to those values, and the counties in blue are the ones that are affected this year in 24 that will see higher property taxes on that farmland coming in 2025. Many of the county auditors have already sent out letters to those people that own farmland and that are enrolled in a current ag use value program to give them a heads up that those values and the property taxes associated with those values are going to increase. There's some language here as far as what actually qualifies for current ag use valuation filed through the county auditor. And just a reminder as well, for those of you who haven't studied this in a while or haven't thought about it much lately, is that these values are determined by using a formula, a net income method of capitalization, where we're looking at the combination of yield and price. We're subtracting total non-land production costs, and we're dividing that by an index rate or a base cap rate or an interest rate, if you will, to come up with the value. Now, the Ohio Department of Taxation, their CAUV department, they assign a value based on this formula and based on historical information in terms of relative yields by soil type. They assign this value based on soil type to over 3,500 soil types throughout the state. So better producing soils will have a higher in the CAUV value, and lower ones will be lower, of course. So the problem we're experiencing right now, and it's not news, is that we have a lag in some of these variables, and we oftentimes will see situations where what we're encountering right now, where we're seeing a downturn in revenue in terms of net income for crop production, while these property taxes are increasing. And the big reason is we're using historic 7 years of data. So we take the county yields, we're looking at actually the state yields for corn, soybeans, and then we're adjusting those based on the given soil type. So we'll come up with those historical pieces of data. The big thing that's driving these increases in CAUV values now and last year were the higher crop prices that have worked their way into the formula. We haven't had enough years of these lower crop prices to impact or start to move that CAUV value down. The other thing that's meaningful for us is interest rates. We had a number of years of very low interest rates in the formula, and we haven't had enough yet of these high interest rates to significantly impact this. But what we expect to see, depending on whether or not we see change in any kind of legislation, if it stays the same, however, we expect to see these CAUV values start to flatten out and actually start to move lower in the next 2 or 3 years. The reason being is these variables are important that go into the formula. Crop prices are decreasing. Production crop costs are remaining pretty flat. And we're going to see higher interest rates working their way into the formula. So this combination will start to bend the curve a little bit back down. So we should see CAUV values declining, maybe not next year, but starting very soon thereafter. Okay, so what are our counties in blue expecting this year on average? And part of the reason why it's such a significant shock to us is that we only see these changes incorporated every 3 years. So each county across the state will see, and they're on a schedule, we'll see a reappraisal or an update every 3 years. The last time those counties in blue saw a change or saw were reappraised. The average soil type across all of Ohio was at $759 an acre. This cycle, 3 years later, we see a significant increase of $1,600 per acre. So it's going to be a meaningful increase in property taxes on those parcels. There's one good piece of news that's come out of this last year, is what the Ohio Department of Taxation has done with the CAUV, and that is incorporated a much higher amount for woodland clearing costs. Many woodlots across Ohio are also enrolled in CAUV, and previously they had a much lower value on clearing those acres of $1,000 an acre. This has been an ongoing conversation, to put it mildly, between ODT and some of the forestry associations that have been involved in this discussion. But what this will mean is that we'll have much lower, and we'll see all of our woodlots down to the minimum level of CAUV values. So that's one good piece of information out there. The Ohio Joint Committee on Property Tax Review and Reform, it was formed as a part of the last biennial budget. They're tasked with coming up with solutions to some of the issues related to property taxes in Ohio. And we expect to see, and they're tasked with giving us a report by the end of this year. So we'll see what kinds of new ideas that they might have that will possibly eliminate some of the real ups and downs of the CAUV, some of the real volatility that we've seen in recent years. We're hopeful. Okay, research and development credit. I almost hesitate to bring this one up, but I think since it's getting some press out there, and that I've heard from several tax practitioners over the last month and a half in our tax schools about this tax credit, it's worth discussing at least briefly. These promoters, or those that are promoting the idea that research and development credits can be used by the typical farmer, we find is a little suspect. Some of these promoters are being very aggressive, contacting not only the farmer, but in some cases going directly to their accountants and trying to encourage them to file these forms that are necessary for the research and development credit. The real question becomes is trying to define what qualifies for this research and development credit on a farm. And these promoters are indicating that something as simple as changing seed varieties or including cover crops on your farm for the first time would qualify. We find this in our discussions to likely be a very aggressive and possibly a position that might not hold up under audit, or would likely not hold up under audit. The part of the question comes from whether or not you qualify for claiming this research and development credit if you have completely new technology or new processes, or a crop that is very unique that you might be including on your farm for the first time, versus what some of these promoters are selling or trying to sell to farmers and those that are doing tax returns. Is it simply just new to your farm? Okay, so something as simple as putting cover crops that have been used on other farms in your community or across the country on your farm for the first time, and doing a very simplified set of test plots. Does this qualify? That's at this point the real conversation that's happening out there, and we find that, at least at this point, some of these aggressive positions might raise red flags, or likely would, and may be disqualified. There are differences of opinion on this, however. Okay. Taxability of USDA discrimination financial assistance, also a part of the Inflation Reduction Act. Those found to have been discriminated against in the past in securing a loan have the opportunity, and in some cases were compensated for that discrimination. It's a taxable award. That's the point that we want to make. So if you are receiving this, make sure that that it's claimed properly. Okay, so there are a couple of slides here on this. If the individual in question, and if it's you, make sure that if the payment that's being claimed and you do receive a 1099-G for that amount, you claim it where it's supposed to be claimed. If you're currently farming, it's going to go on the Schedule F. If you are not farming, it may not be subject to self-employment tax and be claimed on 1040 Schedule 1, Line 8Z, other income. So this is the real this is the piece that we want to make sure that we highlight in this particular subject, is claiming that income if it was received in the appropriate place. Okay, and lastly, some discussion on what's coming. And many of you are aware of this. Many of you have been following this. Robert spent a good deal of time in talking about the pending changes to the estate tax exemption as we look forward to the end of this next tax year and the pending sunsetting or expiration of many of these provisions that we've lived with as a part of tax code and filing our taxes since 2018. So what will this all mean? Well, taxpayers, I think, are very interested. I am, as far as what some of these provisions may do, what Congress may eventually do, and what the administration might actually sign as Congress makes its way through some of this legislation, if it does happen. But there's a lot of these provisions that are they're going to expire at the end of 2025 unless Congress acts to extend them, tweak them slightly. In some cases, they may allow some of these provisions to expire. While they're wrestling with this, they're also wrestling with this issue of increasing federal deficits. So they're trying to solve a couple of problems, and both of them are, well, not to say difficult, they're beyond difficult, I guess, to reconcile tax cuts with also this idea of trying to tame the federal deficits. So you can see here, first of all, the one that will come up first for all taxpayers, the reduction of individual income tax rates and favorable tax brackets that have been a part of our tax code for the last few years. These are set to expire, and then those will increase generally. So we will be seeing some of our income in higher tax brackets if this particular provision is left to expire. Increase in standard deductions is left, it should expire at the end of 25 as well, unless Congress acts. Elimination of personal exemptions, the increase in child tax credits, those will expire as well at the end of this next year. The state and local tax deduction limitation of $10,000. This is also is set to expire, so we'll see what Congress does. Many of those states, those high tax states, want to see this increased substantially. So we'll see how this particular provision changes. One that I'm most concerned about probably is the sunsetting of the qualified business income deduction under Section 199A, the pass-through deduction, that 20% deduction that most farmers benefit from. This is set to expire at the end of 25. The interest expense deduction limitations not expected to impact very many because those limitations are mostly there for extremely high income taxpayers. Changes to the miscellaneous deduction, those are set to expire. So what we would then have is many of those deductions allowable again for claiming on Schedule A, and many of us would then look back to perhaps itemizing deductions that we mostly haven't had to do in the last few years. There's a number of other things there that are included as well. The one thing that would be important in addition to the state tax exemption sunsetting is the bonus depreciation. It's going to continue to work its way down. In 2025, that bonus depreciation amount is going to be 40%. In 26 and 27 continuing to decline. There's been a lot of discussion on what may happen with bonus depreciation. This is going to be a key consideration as they they argue the merits and of extending some of these provisions going forward. Okay. With that, I think we are at a close of this discussion. I mentioned already that what may complicate this debate and the extension of some of these tax provisions is the high federal budget deficit and how they will manage that. Resources. Okay, Farmers Tax Guide's out there, the 24 version. You can access that online. Here's the link. I mentioned earlier also, and David highlighted a couple of the fact sheets that were available from Rural Tax Education. This site is a really great site too for the layperson, so you can access that as well. We're keeping our eyes on, and this is not necessarily tax, but the Farm Bill, of course, disaster relief for production losses, and David in his slides that I mentioned earlier, this is still under consideration. Whether or not we see something by the end of this year, we're unclear. And also the Farm Assistance and Revenue Mitigation Act, the Farm Act. It's not disaster loss, but it's looking at economic loss and assistance to farmers that have suffered as a result of that in this particular tax year. So this is actual legislation that's got language associated with it and has been discussed, but we'll see how that comes out. Upcoming programs, and there's a number of things associated with our that we'll highlight here.
Hey, Barry.
Yeah, go ahead.
So you brought up a discussion about 45Z. Can I interject here before we go to our upcoming programs about 45Q?
Yes. I probably cut you off. Yes, please. Do you want to share your slides?
I'm getting to that right now.
Okay.
So 45Q, Section 45Q tax credit for carbon sequestration might indirectly affect you as a farmer or farmland owner. And so what the Section 45Q tax credit is intended for is for this carbon capture and storage, or sequestration. And that is the process intended to capture man-made carbon dioxide and store it permanently underground. And Congress has incentivized this development of CCS projects through the creation of the 45Q tax credit. And the IRA, the Inflation Reduction Act, actually expanded the tax credit and increased the value of the credit by 70% to $85 per metric ton, decreased the annual capture amount required for a company to be eligible for the tax credit, and it also created the transferability option of the tax credit. So who can claim the tax credit? And that's going to be the owner of the capture equipment, the company, the entity that is capturing that carbon dioxide, injecting it and storing it into the earth, right, underground. So unless you, the farmer or farmland owner, own that equipment to store the carbon and are complicit and compliant in ensuring that the storage or reuse of the carbon, you cannot take the 45Q tax credit. Well, you're thinking, well, why are you even talking about this? Well, because those companies that want to take this 45Q tax credit are probably going to come knocking on your door for a few reasons. And that is because there'll be inquiries into what is known as your pore space beneath your farmland. All right, so companies seeking to store the carbon will want the rights to that pore space beneath your ground so that they can start to capture that carbon, store that carbon, and then claim that 45Q tax credit and possibly sell them to third parties. That's part of that transferability. So they will sell the tax credit to other third-party companies for a fee. And then we'll call these those CCS projects, right? So you have a CCS project come knocking on your door saying, hey, we would like the rights to your pore space. But what is pore space? And that is the empty space between the particles of soil, sand, rock, and sediment beneath the surface of your land. And pore space can be potentially sold or leased to another for those CCS projects. But in Ohio, there is a problem, because before these pore space transactions can occur, there have to be a few legal issues that need to be resolved. And the first one that needs to be resolved is the clarification of who owns the pore space. And Peggy and lost the name I forget their law fellow, but Peggy and our law fellow wrote a blog post that I have linked into the resources here and on your slides that explains more about CCS and the background of CCS, and also clarifies the legal issues that we'll be facing here in Ohio. The second legal issue that we have to discuss in Ohio is how pore space interest can be severed or conveyed. Is this a contractual thing that we should be concerned about? And we know with contract payments versus maybe what could be an easement and a property interest, and how those can affect our taxes. And the last legal issue that we have to talk about is the relationship between a severed pore space interest and the surface of mineral interests, and between surface and mineral interests. And I will say that there's even the issue of what happens with how do we allocate basis maybe to depleted pore space, right? So there's a lot of legal challenges that Ohio faces when it comes to this pore space beneath your ground. And right now we don't have a cognizable legal property right to that pore space other than the common law doctrine of you own everything above and below your ground, right? So we need clarification on that, and that has to come from the Ohio legislature. And so are they going to be tackling these pore space issues is the question. And it's possibly going to happen next year, but not, and certainly not this year. So there were two current proposals in both chambers of the Ohio legislature that declared an intent to regulate carbon capture and storage. But with the year end upon us, it's likely that those bills will not move anywhere. So they'll have to be reintroduced next year when the new legislature comes in. Again, these are some resources. Oh, Zimfer, Peggy and I think it was Alex wrote a carbon capture storage coming soon to Ohio, possibly blog post. Peggy also wrote the legal issues with pore space. And then I put a couple of the Congressional Research Service issues with the 45Q tax credit. And we just wanted to make you aware of the 45Q tax credit, and that it's going to be the driver for what we're thinking is this pore space issue for Ohio farmland owners. Any questions? Seeing none, I will turn it back over to Barry to finish us off. You're muted, Barry, sorry.
Thank you. Yeah, thanks to Jeff. And if our other colleagues have anything else to add to anything, please feel free to jump in. Just a couple of things as we kind of wrap up here, some upcoming programs. I know Eric Rieker has been heavily involved in organizing this OSU Organic Grains Conference upcoming. You can see more information there. Planning for the future of your farm workshops. David Marison and Robert Moore, primary presenters in this particular set of workshops. So if you have an interest, please look there for more information. The Basics of Grain Marketing Workshop. This is something driven or organized by Bruce Clevenger. He's the one that is the contact for this one. So if that's something of interest, be sure to follow up on that. Farm Accounting Workshop with Quicken, also Bruce Clevenger, and there's a number of opportunities to participate in one of these programs. The Farm Online Financial Management course, Eric Rieker is giving leadership to this. This is going to be restarted here for a winter session in January. So more information can be found, and also the OSU Farm Financial Management course, so I'll have some additional information there as well. So please help us today by completing the evaluation when you depart the webinar. Let's see. We've got a question or a comment looking at, well, I think, I'm sorry. Let me read through this question before we adjourn for the day. Okay, that's something that probably would have to type out here, talking about exclusion on sale of a primary residence. Are Our next webinar is going to be January 17th in 2025. And we're almost at the end of the year, boy, so it's hard to believe, but we will be joining you again in January. We look forward to having you all. And let's see, make sure I didn't miss anything else. We've got posts there as far as how to access not only the recorded version of this, which will be up sometime next week. Give us a few days to get that posted, but the slides, I believe, are already posted. Correct, Jeff?
That's
So
right.
you can access those on our Farm Office Live site. So we want to thank you all for joining us, and we'll try to get an answer to this one last Q&A before we actually close the webinar. But for now, we want to wish you, on behalf of all of my colleagues that are here and those that aren't, we want to wish you a wonderful December, Christmas, holiday season, and we look forward to seeing you back in January. And reach out to us if you have any additional questions. We'll be happy to do our best in answering those. So thanks again.